My name Jyoti Gowda. I am studying in KLE College, Ankola. Let us now learn about capital structure.
Capital structure. One of the important decisions under financial management relates to the financing factor or the proportion of the use of different sources in raising funds. On the basis of ownership, the sources of business finance can be broadly classified into two categories. First one, shareholders fund. Second one, borrowed fund. Shareholders funds consist of equity share capital, preference share capital and retained earnings. Borrowed funds consist of debentures, term loans and public deposits. Capital structure refers to the mix between shareholders fund and borrowed funds. These shall be referred as equity and debt in the subsequent test. Debt and equity differ significantly in their cost of debt is lower than the cost of equity for a firm because the lender's risk is lower than the equity shareholder's risk. Since the lender earns an assured return and repayment of capital and they should require a lower rate of return. Next we studied important factors which determine the choice of capital structure. Deciding about the capital structure of a firm involves determining the relative proportion of various types funds. These funds depends on various factors like cash flow position, interest coverage ratio, debt service coverage ratio, return on investment, cost of debt, tax rate, cost of equity, flotation cost, risk consideration, flexibility, control, regulatory framework, stock market conditions, capital structure of other company. First one, cash flow position. Size of projected cash flows must be considered before borrowing. Cash flows must not only cover fixed cash payment obligations, but there must be sufficient buffer loss. It must be kept in mind that a company has cash payment obligations for normal business operations, for investment in fixed asset, for meeting the debt service commitments. That is payment of interest and repayment of principal. Second one, the interest coverage ratio. Interest coverage ratio refers to the number of times earnings before interest and taxes of a company covers the interest obligation. This may be calculated as follows. ICR, interest coverage ratio, equals to EBIT, earning before interest and tax divided by interest. Third one, debt service coverage ratio, DSCR. Debt service coverage ratio takes care of the deficiencies referred to in the interest coverage ratio. The cash profits generated by the operations are compared with the total cash required for the service of the debt and the preference share capital. It is calculated as follows. Profit after tax plus depreciation plus interest plus non-cash expenses divided by preference dividend plus interest plus repayment obligation. Fourth one, return on investment, ROI. If the return on investment of the company is higher, it can choose to use trading on equity to increase its earning per share. That is, its ability to use debt is greater. Return on investment is an important determinant of the company's ability to use trading on equity and thus the capital structure. Fifth one, cost of debt. A firm's ability to borrow at a lower rate increases its capacity to employ higher debt. Thus, more debt can be used if debt can be raised at a lower rate. Sixth one, tax rate. Since interest is a deductible expense, cost of debt is affected by the tax rate. The firms in our examples are borrowing at 10% since the tax rate is 30%. The after-tax cost of debt is only 7%. A higher tax rate thus makes debt relatively cheaper and increases its attraction vice versa equity. Seventh one, cost of equity. Stock owners expect a rate of return from the equity which is commensurate with the risk they are assuming. When a company increases debt, the financial risk faced by the equity shareholders increases. Consequently, their desired rate of return may increase. If debt is used beyond that point, cost of equity may go up sharply and the share price may decrease in spite of increased earning per share. Consequently, for maximization of shareholders' wealth, debt can be used only up to a level. Eighth one, flotation cost. Process of raising resources also involves some cost. Public issue of shares and debentures requires considerable expenditure. Getting a loan from a financial institution may not cost so much. These considerations may also affect the choice between debt and equity and hence the capital structure. Ninth one, risk consideration. As discussed earlier, use of debt increases the financial risk of a business. Financial risk refers to a position when a company is unable to meet its fixed financial charges, namely interest payment, preference dividend, and repayment obligations. Apart from the financial risk, every business has some operating risk, also called as business risk. 10th one, flexibility. If a firm uses its debt potential to the full, it loses flexibility to issue further debt. To maintain flexibility, it must maintain some borrowing power to take care of unforeseen circumstances. 11th one, control. Debt normally does not causes a delusion of control. A public issue of equity may reduce the management's holding in the company and make it vulnerable to takeover. This factor also influences the choice between debt and equity, especially in companies in which the current holding of management is on a lower side. 12th one, regulatory framework. Every company operates within a regulatory framework provided by the law. For example, public issue of shares and debentures have to be made under SEBI, means Securities Exchange Board of India's guidelines. Raising funds from banks and other financial institutions require fulfillment of other norms. 13. Stock market conditions. If the stock market are bullish, equity shares are more easily sold even at a higher price. Use of equity is often preferred by companies in such a situation. However, during a bearish phase, a company may find raising of equity capital more difficult and it may opt for debt. Thus, stock market conditions often affect the choice between the two. 14th one, capital structure of other companies. A useful guideline in the capital structure planning is the debt equity ratios of other companies in the same industry. There are usually some industry norms which may help. Care, however, must be taken that the company does not follow the industry norms blindly. For example, if the business risk of a company is higher, it cannot afford the same financial risk. It should go in for low debt. Thus, the management must know what the industry norms are, whether they are following them or deviating from them, and adequate justifications must be there in both cases. These are all factors affecting capital structure.